Everyone knows governments take their money. What most people don't realize is that the paycheck deduction they complain about is actually the least creative thing the state does to extract wealth from you. There are at least 8 distinct mechanisms, some so hidden you'd never notice them. Today I'm breaking down every single way governments make money, from the obvious to the borderline sinister. Starting with the one you already hate: direct taxation. This is the one everyone knows about. You see it on your payslip, you file a return once a year, and politicians won't shut up about it during election season. Income tax is the flagship of government revenue, with progressive marginal rates that climb from near zero up to 50% for top earners. Here's the thing though, most people still get it wrong. The number one misconception is that moving into a higher bracket means all your income gets taxed at the new rate. It doesn't. Only the income above the threshold gets hit harder. Your first dollars are still taxed at the lowest rate. Always have been. Now, corporate income tax dominates headlines, but only generates about 5 to 10% of total tax revenue, which is, not ideal. But here's where it gets interesting. Payroll taxes, the ones your employer pays on your behalf, can rival or exceed income tax revenue. Most workers never see that number because the employer share doesn't appear on their payslip. Your labor costs your company significantly more than your salary suggests, and that invisible gap goes straight to the government. If you think direct taxation is hard to miss, wait until you see how governments hide taxes inside every single thing you buy. Consumption taxes. Here's where governments get sneaky. Income tax is obvious. You see it disappear from your paycheck every month. But consumption taxes? They're baked into the price of everything you buy, and most people never think twice about them. VAT is the dominant form worldwide, and it's genuinely elegant from a government's perspective. Standard rates across Europe sit between 17 and 25%, generating roughly a fifth to a third of total tax revenue. But here's what makes VAT different from a simple sales tax. It's collected at every stage of production. Each business charges VAT on what it sells, then claims back what it paid on inputs. To claim that credit, you need a proper invoice from your supplier. Your supplier needs one from theirs. Everyone is essentially snitching on everyone else. Which is, not ideal if you're trying to commit tax fraud. Then you've got excise duties, fuel, tobacco, alcohol. Governments love these because of inelastic demand. People keep buying cigarettes and gasoline even as prices climb. Jack up the tax and the revenue just keeps flowing. But the fundamental problem with consumption taxes is they're regressive. A person earning $20,000 a year spends almost all of it. A person earning $200,000 doesn't. So the lower earner pays tax on a far higher share of their income. Cool, add that to the list. And then there's the presentation trick. In countries with VAT-inclusive pricing, the tax is invisible. You never think, wow, 20% of what I just paid went straight to the government. Governments figured this out a long time ago. I don't know what to tell you. But if you think taxing your spending is the sneakiest move in the playbook, wait until you hear how governments make money by spending money they don't have. Government borrowing. Here's where things get clever. Everything up to this point has been obvious. You earn money, the government takes a cut. You buy something, the government takes a cut. Borrowing is different because it lets governments spend money they don't have yet, and nobody sends you a bill. Technically, borrowing isn't revenue, but in practice, it pays for the exact same things taxes do. Salaries, roads, hospitals, military equipment. The money hits the treasury and gets spent identically to tax dollars. The only difference is where it came from and who eventually pays for it. Most advanced economies carry public debt somewhere between 60 and 120% of their entire GDP. That's not a rainy day credit card. That's a structural feature of how modern states operate. The annual deficit gets filled by selling bonds to investors who trust they'll get paid back, with interest. And here's the thing, borrowing is just taxation with a time machine. When a government issues a 30-year bond today, it's committing taxpayers in 2055 to cover that bill. People who might currently be in elementary school. People who never voted for the spending and will inherit the interest payments whether they like it or not. So why do governments love it? Elections. A politician who raises taxes loses their job. A politician who borrows gets credit for new programs, and the repayment lands on whoever's in office 2 decades later. The incentive structure is almost comically broken. Citizen awareness of all this is basically zero during normal times. Nobody gets an invoice saying your share of the national debt increased by $400 this month. Awareness only spikes during fiscal crises, when austerity hits and everyone's asking where the money went. By then, it's already been spent. But if borrowing lets governments tax people who haven't been born yet, wait until you hear what happens when they skip the middleman entirely and just create the money from nothing. Money printing. Here's something governments figured out a long time ago. If you can just create money to pay your bills, why bother taxing anyone? The answer historically is hyperinflation. People wheelbarrowing cash to buy bread, economies collapsing overnight, so most modern countries made direct money printing illegal for governments. Problem solved, except not really, because they found a workaround. It's called quantitative easing, and here's How it works. The central bank creates new reserves out of thin air and uses them to buy government bonds. This lowers borrowing costs for the government and generates profits on those bonds, which the central bank then sends back to the treasury. Billions per year in large economies, just quietly wired over like a dividend from a company that didn't exist 5 years ago. Now technically, this isn't printing money. Economists will be very firm about that distinction. But the practical effect is similar. The government's borrowing gets cheaper, and money that was conjured from nothing ends up funding public spending. The whole thing operates through central bank balance sheets and reserve markets, which is a polite way of saying almost nobody on Earth actually understands how it works. But here's where it gets complicated. When interest rates rise, those bond portfolios lose value. The central bank starts bleeding money. And who has to bail out the central bank? The government. The same government that was receiving billions in profit just months earlier is now writing checks to cover losses, which is, not ideal. And all of this gets decided by unelected technocrats. No vote, no referendum, just a room full of economists deciding to boost asset prices, which conveniently makes wealthy homeowners and stockholders richer, while everyone else wonders why everything costs more. But at least QE is technically reversible. The next section covers government revenue that gets taken from people directly, sometimes before they're even convicted of anything. Fines and forfeiture. Here's a fun question for you. What happens when the people enforcing the law have a direct financial incentive to find you guilty of breaking it? Because that's exactly how parts of the system work. On paper, fines exist to deter bad behavior. Traffic tickets, regulatory penalties, court fees. Nationally, this stuff accounts for well below a few percentage points of total government revenue. Barely a rounding error. But zoom into local governments and the picture gets much darker. For some police departments and municipal courts, fines and forfeitures aren't a minor line item. They're a primary funding source. The department's budget literally depends on how many violations they find. And then there's civil asset forfeiture, which is where things get genuinely insane. Law enforcement can seize your property, your car, your cash, your house, based on a suspicion that it's connected to criminal activity. Not a conviction, not even a charge, a suspicion. And in many places, the agency that seized your stuff gets to keep the proceeds. Cool. That's also a thing that happened. So now you've got a system where police departments can take your property without proving you did anything wrong, and then use the money to buy new equipment. The conflict of interest isn't subtle, it's structural. The burden falls exactly where you'd expect. Low-income communities who can't afford attorneys to fight a 2-year legal battle over a seized vehicle, people who do the math and realize contesting the forfeiture costs more than the property is worth. Everyone who's ever gotten a speeding ticket knows fines exist, but almost nobody thinks of them as part of a revenue strategy. But if you think perverse incentives are bad, wait until you see what happens when the government just skips the middleman and runs the businesses, directly state-owned enterprises. Some countries have essentially figured out how to fund a government without taxing their people, and it creates some of the weirdest political dynamics on the planet. Here's how it works. Instead of taxing citizens, the government just owns businesses. Energy companies, airlines, telecoms, banks, mining operations. These state-owned enterprises generate revenue through commercial activity, selling oil, running railways, exporting natural gas, and the profits flow directly into the national budget as dividends. In resource-rich nations, national oil companies alone can provide the dominant share of government revenue, and we're talking countries where income tax basically doesn't exist because the state's oil company is printing money faster than any tax system ever could. But here's where it gets interesting. Some of these countries took it a step further. They created sovereign wealth funds, which are essentially giant investment portfolios funded by surplus resource revenue. These funds invest billions into global stocks, bonds, real estate, entire companies, and then transfer a sustainable annual drawback into the budget. Your schools might literally be funded by returns on a government stake in a European tech company, which is, not something most people think about when they drop their kids off in the morning. The dark side is what political scientists call the rentier state phenomenon. When citizens aren't being taxed, they tend to demand less accountability. Makes sense. If the government isn't taking money out of your paycheck, you feel less entitled to ask where it's going. Taxation creates a feedback loop of accountability. Remove it, and that loop breaks. And when these enterprises are poorly managed, they flip from revenue source to revenue drain. Suddenly, the government is subsidizing a failing airline with money that could have built hospitals. The citizen doesn't see a tax bill, but they're absolutely paying for it. If you think owning businesses is a creative way to fund a country, wait until you hear about the profit governments make from literally creating money out of thin air. Seigniorage. Here's a concept that almost nobody knows about, and once you hear it, you'll never look at cash the same way again. Every time a government prints a banknote, it makes money. Literally. A bill costs roughly 30 cents to produce, but it enters the economy at face value. So that $100 bill in your wallet, the government made about $99.70 in profit just by printing it. They take that freshly minted cash, swap it for interest-bearing assets like government bonds, and then sit back collecting returns on something that cost them pocket change to create. And this isn't some modern trick. This goes all the way back to medieval kings who figured out something clever. You take a gold coin, melt it down, mix in some cheaper metal, stamp it with the same face value, and pocket the leftover gold. They called it debasement, and it was essentially a king skimming profit off his own currency, which is, exactly what it sounds like. The modern version is cleaner, but the principle is identical. The government holds a monopoly on creating money, and that monopoly generates profit. In most developed economies, this adds up to a fraction of a percent to a few percent of GDP annually. Modest, but persistent. Free money, forever, and almost nobody notices. Here's where it gets interesting though. As the world goes cashless, this revenue stream starts drying up. Fewer physical bills in circulation means less seigniorage. And that's one of the real reasons central banks are suddenly very interested in digital currencies. CBDCs aren't just about convenience or fighting crime, they're about preserving a revenue stream that's quietly existed for centuries. In wealthier nations, seigniorage is a nice bonus. In low-income countries with limited ability to collect taxes, it becomes genuinely important, sometimes overlapping dangerously with just printing money to cover expenses. But if the profit from printing money sounds like a subtle way to extract value from citizens, wait until you hear about the government's most invisible trick of all: inflation. Every mechanism we've covered so far has something in common. Someone had to vote on it, sign it, or at least send you a bill. And this one doesn't need any of that, and inflation erodes the purchasing power of every dollar you're holding, every dollar in your savings account, every dollar in your wallet, every dollar your grandmother tucked into a birthday card. It does this automatically, constantly, without legislation, without a collector, without a single line item on any statement you'll ever receive. In fiscal terms, the perfect crime. Here's how it works as a revenue tool. The government creates money faster than the economy grows, prices rise, and the real value of your cash holdings quietly evaporates. The revenue generated is roughly the inflation rate multiplied by the total real money balances in the economy. Print too much though, and people flee cash entirely, shrinking the base you're taxing. It's a Laffer curve that nobody voted on. And here's where it gets genuinely ugly. This tax falls hardest on people who hold cash and fixed income assets. Grandma's savings account gets eaten alive while the government, sitting on trillions in nominal debt, watches its real obligations shrink. Unexpected inflation is functionally a tax on bondholders that looks nothing like a default but achieves the same result. The kicker? People notice rising prices every single week at the grocery store, but almost nobody frames it as taxation. They blame corporations, supply chains, abstract economic forces. Meanwhile, fiscal and monetary policy choices sit quietly in the background, unaccused. And that's the full picture. 8 mechanisms, ranging from the tax on your payslip that you see every 2 weeks to an invisible force reshaping your purchasing power while you sleep. Once you understand all 8, you stop seeing government revenue as a single dial and start seeing it as a spectrum from democratic consent to silent extraction. If you enjoyed this video and want to see more, click the video on the screen now.